Hello and welcome to the Daily Brief Show by Zerodha. Here we cut through the noise and bring to you the most important stories that move the markets. I am your host Anurag Bansal, and in this episode we'll talk about 6 very interesting stories. We'll start by talking about some changes that have happened in the F&OH segment recently. Second, we'll look at whether or not the telecom wars are still on or things have cooled down now. Third, we'll understand how Blackstone and Haldiram's deal might finally come to a close. In the fourth story, we'll see how the life of a PMS manager has just become a little more harder. In the fifth story, we'll talk about MapMyIndia and Ola's legal battle. And in the last story, we'll talk about India's love-hate relationship with China. By the way, this show is also available on Spotify, Apple Podcasts, YouTube Music, and also as a video on YouTube. You can choose wherever you consume your shows. We also send out a daily brief newsletter every morning that captures in text everything that we have discussed through the day. So if you are interested, do subscribe using Substack. Now starting with the first story, we'll look at how SEBI is worried about the increasing number of people trading in F&OH who are losing money. See, in the last fiscal year, 92.5 lakh unique investors traded in index derivatives and 85% of them incurred net trading losses. Now that number is huge. So SEBI recently formed a committee to get recommendations on how to reduce speculations in the market. The committee then made its recommendations, based on which SEBI published a consultation paper yesterday. I'll briefly talk you through what SEBI is proposing in very quick pointers. See, right now 6 weekly options contracts are available on multiple indices like Bank Nifty, which expires on Wednesday, Nifty, which expires on Thursday, and Sensex, which expires on Friday. But SEBI is now proposing to restrict weekly option contracts to major benchmark indexes. So for example, it could only be the Nifty and Sensex options which expire weekly, and the rest of the contracts would expire monthly only. The next is that the calendar spread benefit might go away on the expiry day. See, I'll explain this. When you hold 2 options on the same index but with different expiry dates, you usually get a margin benefit. This basically is called a calendar spread. The next proposal is that on expiry day, the margin required will go up by 1 to 3% of the contract value. The last time SEBI had reviewed the contract sizes was back in 2015, and since then the markets have grown exponentially, so it is now proposing to increase them again by about 3 times. Currently, the value of an index derivatives contract is between 5 to 10 lakhs, but it might be increased in a phased manner from 15 to 20 lakhs and then from 20 to 30 lakhs after 6 months. Moving on to the next story, let's talk about how telecom wars are maybe slowly drying down now. See, before 2010, telecom was one of the hottest sectors. Everybody, including the biggest industrialists in India, wanted a piece of the action. But then people slowly started to realize that telecom is a capital-hungry industry, and over the next decade or so, the number of casualties in this industry increased by quite a lot. The likes of Uninor, Tata Docomo, Arcom and Aircel all either got acquired or just shut down. Today, the telecom industry is only dominated by players like Bharti Airtel and Reliance Jio. A couple of other players like Vodafone Idea, BSNL and MTNL also exist, but they're really struggling with all sorts of problems. Interestingly, telecom stocks were among the worst performing investments over the last decade or so, but now things slowly seem to be changing. The last big event in this sector was Reliance Jio's entry with its free plans. Now thanks to its pricing, Jio very quickly gained market share at the expense of companies like Vodafone and BSNL. Today Jio is the only dominant player remaining apart from Airtel. By the way, here's a fun question for you. Can you guess who was the market leader of telecom back in 2018? Let me answer. Believe it or not, it was Vodafone. Vodafone had a market share of close to 35 to 40% of mobile subscribers back then. Now, because of Jio and Airtel's rise, it has now fallen down to less than 20%. Vodafone Idea could basically never get its act right. Given the massive investments required in spectrum and the pricing wars due to Jio, they accumulated massive amounts of debt and they never stood a chance against Airtel and Jio. They basically had to be saved by a bailout by the government of India, and now they're in such bad shape that they are paying dues to their suppliers by giving shares instead of money. S&P recently published a report on the sector which had some very interesting insights that you might want to know. According to the report, since Jio and Airtel are the only remaining players, this means that they can now focus on just improving their financials instead of engaging in price wars like they had to do earlier. Now, given that the telecom sector is very capital heavy and both these companies have already invested heavily to roll out 4G and 5G services, any increase in tariffs will now directly go to the bottom line to improve their profitability. Recently, Jio took the first step and announced an increase in tariff prices. They were soon followed by Airtel and Vodafone Idea as well. All of them raised prices by about 10 to 25%, and this was the first significant across-the-board price hike ever since November 2021. Now, all of these companies' focus seems to be on generating more revenue per user. Sunil Bharti Mittal, who's the chairperson of Airtel, said in an interview with ET, and I quote, "We have spent nearly 80,000 crore rupees on 5G spectrum and rollout. Our competitors have spent more than 100,000 crore rupees and there are no additional revenues, as you know. So the time has come now to start rationalize and repair tariffs." He further said, and I quote, "I think we are heading towards an ARPU of 300 rupees and I hope it happens within the coming financial year, which we are entering from April 1st. We need more investments into fibers, infrastructure and rural areas." Now, although price hikes can lead to some customers dropping their plans or switching to cheaper options, data consumption habits usually tend to be very sticky. In simpler words, once a customer is used to a certain data usage level, they are likely to continue using similar amounts of data even if the prices go up. I'll put it in numbers to explain this simply. During the March quarter, people used over 5,000 crore GBs worth of mobile data. This is almost double the amount of mobile data that they used 3 years ago. One interesting insight about the telecom sector is that every 10 rupees increase in ARPU or average revenue per user will translate into an annual EBITDA boost of 2,500 crore rupees and more for Bharti Airtel and 3,000 crore rupees and more for Reliance Jio. The telecom companies expect the ARPU or average revenue per user to continue rising as they implement more rounds of tariff hikes. These higher ARPUs will help telecom companies recover all their investments that they had to make in network infrastructure, including the recent rollout of 5G services. Now, interestingly, the government is being forced to help the smaller telecom players now so that they don't die. MTNL, which is another struggling player in the telecom sector, was about to default on bond interest payments just a few weeks ago. The government was just forced to pay this because of a guarantee. The government also stepped in to save BSNL last year. They approved a big rescue package worth more than rupees 80,000 crores to boost BSNL's 4G and 5G capabilities. Now, moving on to the next story of the day, Blackstone, which is one of the world's biggest private equity firms, is looking to buy a 51% stake in Haldirams. This story has been going on for quite some time now, but this time it looks like everything has progressed. I'll break things down for you very simply. See, Blackstone, Abu Dhabi Investments Authority and Singapore's GIC are bidding about 40,000 crore rupees to buy a 51% stake in Haldirams. If this deal goes through, Haldirams will be valued between 70,000 and 78,000 crore rupees, and this will become one of the largest private equity buyouts in India, which is a huge deal. Now, if you followed the news recently, you probably know that the Haldiram story has been going on for quite some time now, but it just doesn't seem to see a close. This is partly because of issues about who would own Haldiram's restaurants and the brand license after the deal closes. But now, according to anonymous sources reported by Money Control, these issues have now been resolved. If the deal goes through, Blackstone will control Haldiram's product business and they will get a permanent license to use the Haldiram brand. On the other hand, the Haldiram family will keep control of the restaurant operations and they will get an annual royalty fee for the usage of the brand. If everything goes as per plan, we might end up hearing confirmed news in the next 6 to 8 weeks. Interestingly though, BlackRock has been denying any truth in this story. On the other hand, internally, Haldiram as a company seems to be restructuring to get ready for this deal. The Delhi and the Nagpur branches of the Haldiram's family have merged their business into a common new entity which is now called Haldiram Snacks Food Private Limited. The Delhi branch will own 56% of the new company while the Nagpur branch will own about 44% of it. This merger has also gotten approval from the Competition Commission of India. Now, all of this got me curious about two questions. One is, why is Blackstone so interested in Haldirams? And the second one is, what will a PE firm even do with Haldirams after buying it? If you also have these questions in mind, let me tell you what I found out. For the first question, see, Blackstone has been investing in India for over 16 years now. Their strategy is to bet big on the growing middle class population and the young population of our country. According to them, Haldirams is a great bet to reach this very audience. For the second question, I'll take a minute and explain how a PE or a private equity firm actually works. See, when a PE firm like Blackstone buys a company like Haldiram's, it is usually not entirely with their own money. They do it with a mix of their own money and some borrowed capital from banks. The interesting thing here is that the capital borrowed from banks is not on the balance sheet of the PE firm, but rather on the balance sheet of the company that they are now buying. In this case, the owners or the promoter of the company being sold get all their money and they move out of the picture. The PE firm then sets up their own new management to run the company and hopes to grow it. The larger idea here is to grow it to a level where they can either IPO it or sell it further and eventually make a larger profit than what they bought it for. Now, if this specific Haldiram's deal goes through, it'll be really interesting because PE investments in India were at a 6-year low in FY24 and this deal could be like a revival. Globally, however, PE and VC firms have had a record $2.62 trillion worth of uncommitted capital right now. This means they have gotten a lot of money, but very few places are available to deploy it. Therefore, they seem very interested to turn their heads towards growing markets like India. The world's biggest PE firms like KKR, Blackstone, etc. are very visibly bullish on India. Most of them have already announced significant investment plans for the coming years in our country. The next story of the day is a small snippet about the implications of the recent LTCG or long-term capital gains and STCG or short-term capital gains tax hikes. See, most of us by now know that the finance minister increased the long-term capital gains tax from 10% to 12.5% and the short-term capital gains tax from 15% to 20% in the recently announced budget. Now, while this move is aimed at controlling the activity in the markets, it is going to make life very tough for certain types of investments. I'll give you some context to explain what I'm talking about. See, when you invest in a mutual fund, you pay either LTCG or STCG depending on how long you hold it for. But the beauty of mutual funds is that you don't really pay taxes on the trades happening inside the fund. So basically, if a fund manager buys and sells the stocks within 6 months, you don't pay any taxes on that. You only pay based on your holding period of the larger fund. But this is not really the case for portfolio management services or PMSs and alternate investment funds or AIFs. In the case of a PMS, your investments aren't really pooled in like mutual funds. They happen in a demat account in your name. So you're basically taxed as if you had invested on your own. The same deal applies to category 1 and also category 2 AIFs. Now, because of this capital gains tax hike, both PMS and AIFs will need to generate about 2 to 4% more returns only to match the post-tax returns of an average mutual fund. Now this, as you would imagine, is a big ask. Now, in case you're of the school of thought that 2 to 4% is not too much, I'll tell you that most active mutual funds don't even beat their basic benchmarks. Imagine a PMS trying to do it with all that tax disadvantage. Moving on to the next story of the day, MapMyIndia, which is one of India's biggest digital mapping companies, has sued Ola Electric, which is the country's largest electric two-wheeler manufacturer. I'll explain what is going on. MapMyIndia says that Ola has copied their data to build their own Ola maps. They claim that Ola has cached and saved their data and reverse engineered a licensed product. Now, the root of this argument stems from an agreement that Ola Electric and MapMyIndia had signed back in June 2021. The agreement had apparently prohibited Ola from co-mingling or mixing and reverse engineering MapMyIndia's data to create their own map service. Now, according to MapMyIndia, that is exactly what Ola Electric has done with Ola Maps, and that is why they are suing them. Now, this is a big deal because Ola, MapMyIndia and Google Maps are currently in the news for competing against each other to capture the Indian mapping market. While MapMyIndia has shown impressive growth in the last few years, they are facing threat from Ola because of their recently announced map service and also by Google, which decided to reduce its map prices by 70% in India. If Ola's claim is to be believed, Ola Maps will be able to address India-specific challenges that the Western mapping apps struggle with. They're using AI algorithms and real-time data from millions of vehicles, and this is something MapMyIndia could potentially be worried about as well. For now though, Ola Electric is denying MapMyIndia's allegations. They are saying that the claims are false, malicious and misleading as well. Now, the reason why I'm talking about this legal battle is because it could have significant implications for India's mapping industry. It is especially interesting because Ola Electric is preparing for its IPO very soon. So it'll be very interesting to wait and watch to see how this story unfolds. I'll make sure to cover this as and when there is more information on this that is available. Now, in the last story of the day, let's talk about India's love-hate relationship with China. See, last week I had spoken about how India wants to now be friends with China again. Here's a a clip from that episode to give you a quick recap. See, India and China have had a rocky relationship since their border clash in 2020, but it looks like things are improving now. India still wants China to fix the border issue, but it also needs Chinese technology and investments to boost its industries. In fact, despite all the push for Make in India, it is still a little hard for India to manufacture everything all by themselves. Whether we accept it or not, we will still have to rely on China for certain things. Yesterday, Piyush Goyal, who's India's Commerce and Industry Minister, poured some cold water on this by saying that there is no plan to support Chinese investments despite what the economic survey suggested. Now, even though Chinese investments are very tiny in India, which is about 0.37% of our total FDI since 2000, our trade with China is huge. China is our biggest trading partner with trade worth more than 9,70,000 crores in just the last 1 year. We sell them iron ore, cotton, spices and veggies and buy a lot of electronics and machinery from them. The political tensions continue to remain high, but there are some selective areas where things seem to be getting better. There is also a growing recognition in the government that they cannot ban everything from China. Whether we like it or not, we need to work with China in some capacity. For instance, Indian solar companies like Tata Power Solar, Renew Photovoltaic and Avada Electronics need Chinese experts to help them scale up their operations and meet our renewable energy goals. They are asking for visas for Chinese engineers and technicians who are crucial for their projects. Tata Power, for example, is investing 3,000 crore rupees in a new solar manufacturing plant in Tamil Nadu, and they need these experts to get it done for them. Without their help, projects could be delayed by quite a bit. Interestingly, the economic survey suggested that partnerships between Indian and Chinese companies could be a good idea in fact. These joint ventures or JVs would then let Chinese firms get around US restrictions by making goods in India and then exporting them to US. This would help them take advantage of India's better relationship with the West. But setting up these partnerships is not without problems. Making stuff in India is more expensive than making stuff in China. We also don't have the necessary technical skills, the infrastructure, and the extended ecosystem. The very fact that we have visa and import restrictions also does not help. To make these joint ventures work better, India needs to lower tariffs, improve the production linked incentive scheme or PLI scheme, and make it easier for businesses to operate. By doing this, we can make partnerships more attractive and also boost our manufacturing capabilities. So even though there is tension on the political front, economic needs are forcing cooperation between these two countries. That's all the news I have for you today. I'll see you in tomorrow's episode. I hope you found value in this. Take care and goodbye.